Welcome to vTalkInsight, Allocator's Lens Daily for March 20th, 2026. Energy shocks from the Gulf have moved from temporary disruption to potential structural damage, with oil near $120 and European gas prices jumping, while central banks lean toward higher for longer and equities finally start to wobble. Cross-asset correlations are shifting as stagflation risk builds. So let us unpack how this new phase is feeding through equities, rates, credit, foreign exchange, and commodities. In equities, the combination of a severe Gulf energy shock and a sharp reset in rate expectations is now being felt more clearly in prices. European indices opened sharply lower, with major benchmarks down over 1%, and some markets off more than 2%, as surging oil and gas costs collide with already fragile growth. Energy producers are among the only clear winners, while banks, autos, travel, and basic resources lag, and broad European and Asian bourses remain under heavier pressure than the United States. In the U.S., pullbacks have been milder, but volatility gauges in the mid-20s and a break below the 200-day moving average for the S&P signal rising risk aversion and weaker market breadth. Under the surface, AI-linked franchises highlight the tension between strong micro fundamentals and macro headwinds. Memory makers such as Micron are delivering powerful revenue beats, guiding to very high margins and signaling that supply will stay tight into the later part of this decade. Yet the stock sold off on worries about peak cycle, rising capital expenditure above $25 billion, and a general de-risking away from the most extended winners. Accenture has just raised guidance on record AI-related bookings and strong free cash flow. And yet European equity indices are still under pressure as energy importers face a worse inflation growth trade-off. Allocators report trimming equity overweights and adding liquidity, while many still view U.S. pullbacks as pauses rather than a confirmed regime break. The key question is whether sustained triple-digit oil and higher yields force a broader wave of earnings downgrades beyond the energy and AI beneficiaries. Turning to rates, the dominant theme is a forceful higher for longer repricing at the front end of curves. In the United States, two-year Treasury yields have jumped more than 30 basis points to around 3.8%, now trading above the upper bound of the Fed funds range and signaling that markets no longer expect rate cuts anytime soon. Recent Fed communications emphasize that cuts are unlikely until there is clearer progress on inflation, and updated projections show only one cut this year and one next year, even as officials acknowledge downside risks to growth and employment. Energy-driven inflation shocks are pushing short-term inflation expectations higher. And while longer-term expectations remain anchored for now, the bar for additional hikes is high, leaving the Fed reactive to incoming data rather than setting the macro agenda. Europe and the United Kingdom are experiencing similar dynamics with an added stagflation twist. The European Central Bank and the Bank of England have both held policy rates, but markets have swung from pricing cuts to expecting meaningful further tightening, with roughly 50 to 60 basis points of additional hikes implied by year-end in both jurisdictions. Front-end gilt yields have surged more than 30 basis points and are rising faster than core European peers, as the Bank of England turns more hawkish in response to persistent inflation and higher energy costs despite weak labor data. For allocators, this means policymakers are likely to tolerate slower growth to prevent inflation expectations from drifting, and the combination of higher real yields and elevated policy uncertainty keeps duration risk significant even as bonds attract inflows as a relative safe harbor. In credit, headline indices remain relatively orderly, but the stress is building underneath, especially where leverage and illiquidity intersect. Household balance sheets are showing more cracks, with auto loan delinquencies back at financial crisis peaks and credit card delinquencies rising, a worrying backdrop when energy prices near $100 are already squeezing lower-income consumers. Private credit vehicles are under particular scrutiny, as semi-liquid funds face redemption pressure from the wealth channel, just as top-line growth slows and higher base rates bite. Concerns center on liquidity mismatches, opaque valuations, and the use of private credit in retirement accounts, while regulators in Europe have become more vocal about the risks after some funds gated withdrawals. At the same time, some features of the current environment are lender-friendly rather than outright destabilizing. With policy rates expected to stay above zero and spreads widening on recent dislocations, New private credit deals and rescue financing in senior parts of the capital structure are coming with higher coupons and stronger covenants, offering potentially attractive contractual cash flows relative to the ultra-low rate years. U.S. regulatory changes that modestly lower capital requirements for large and regional banks may also free up incremental lending capacity, even as European bank equities underperform on stagflation fears and exposure to volatile energy markets. The big question for credit allocators is whether current strains in households, hedge funds, and private vehicles stay contained or evolve into a broader contagion episode if the energy shock and higher yields persist longer than currently embedded in growth forecasts. Foreign exchange markets are mediating many of these cross-asset tensions. Despite talk that the dollar could weaken over time if the Fed eventually cuts while the European Central Bank stays on hold, recent turmoil has seen the greenback strengthen again as a classic safe haven, supported by deep liquidity and the U.S. position as a relative energy winner. The euro, by contrast, has slipped against the dollar over the past few weeks, reflecting doubts that the ECB can ease policy meaningfully while facing higher imported energy costs and stickier inflation. That currency pressure tightens financial conditions in Europe, just as growth forecasts are being revised lower, reinforcing the regional underperformance already evident in equities and banks. Elsewhere, traditional safe havens are behaving in more nuanced ways. The Swiss franc remains strong, helping to dampen imported inflation, but policymakers have signaled a willingness to intervene to prevent excessive appreciation and avoid a return to negative rates. The Japanese yen is widely seen as significantly undervalued, and some investors favor unhedged holdings of longer-dated Japanese government bonds on the view that, even if short rates rise, long-term yields will be capped. Commodity exporters with their own energy resources remain structurally better positioned than importers, but the current phase shows that geopolitical location, policy reaction functions, and balance of payments dynamics can matter as much as simple terms of trade when thinking about currency risk in multi-asset portfolios. Commodities remain the fulcrum of this entire narrative, and the story has clearly shifted from temporary disruption to potential structural squeeze. Escalating attacks across the Gulf have caused significant physical damage to energy infrastructure, including major liquefied natural gas facilities in Qatar that account for a large share of global supply, as well as refineries and gas fields in Iran and Saudi Arabia. The Strait of Hormuz is effectively constrained. War risk insurance premia for tankers have jumped from around 0.5% of vessel value to as high as 3 to 7%, and Gulf producers are reportedly shutting in close to 10 million barrels per day because they cannot move product into constrained storage and shipping networks. Brent crude has spiked, trading in a wide band between roughly $108 and $119 and threatening to move higher if disruptions last 4 to 6 weeks or more, while European gas prices have jumped over 30% in a single session. The damage to Qatar's export complex is particularly important because some estimates suggest that around 17% of its liquefied natural gas capacity could be offline for years, not months, raising the risk of a prolonged global gas deficit and higher prices in both Europe and Asia. Global annualized spending on crude oil products has already risen from about $2.5 trillion to $4.5 trillion, approaching levels seen during past oil shocks. And that energy cost surge is now feeding into fertilizer shortages and higher agricultural prices, with corn and other crops likely to feel the pinch into the next planting and harvest cycle. Industrial metals, such as copper and aluminium, have sold off as higher oil and higher rates darken the growth outlook, while gold has perplexingly dropped nearly 4% intraday despite geopolitical risk, suggesting shifting views on inflation hedging and safe havens. For a multi-asset lens, the durability of elevated oil and gas prices, rather than the absolute level on any given day, will drive whether this episode remains a manageable terms of trade shock or evolves into a more entrenched stagflation regime that forces further repricing across equities, rates, and credit. Stepping back across assets, today's picture is one where a deepening Gulf energy shock is colliding with a decisive higher for longer shift in interest rate expectations. Equities are adjusting with more visible stress in Europe and Asia, while U.S. markets still lean on AI-driven earnings and energy independence, even as valuations and breadth look more fragile. Rates markets are doing the heavy lifting of policy repricing. Front-end yields are back near recent highs, and credit is caught in the middle, with household delinquencies and private credit liquidity strains creeping higher, but not yet systemic. The dollar and selected safe havens remain firm, amplifying pressure on energy importers, and commodities continue to anchor the macro narrative as physical damage to infrastructure and shipping lanes extends the likely duration of disruption. For allocators, the key watch points are the timeline for restoring Gulf capacity, any sign that inflation expectations are drifting away from central bank targets, and whether emerging credit cracks widen into something more contagious. Those signals will determine whether today's repricing stabilizes into a softer landing or evolves toward a harder landing scenario over coming quarters. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.